Policy presented by the Reserve Bank of India was being watched out today, not so much for an expected change in rates. It was widely known and expected that rates wouldn't be tweaked much, and that's exactly what happened. But what people were keen to know is what the Reserve Bank of India is saying officially about a rise in COVID cases, how it plans to tackle it, what is its growth and inflation outlook. So some very important statements coming in from Reserve Bank of India Governor Shaktikanta today. The growth outlook has remained pretty stable. The inflation outlook has been tweaked slightly upwards, so inflation could remain a cause of concern over the next 1 year to come. But importantly, it seems fairly clear that the Reserve Bank of India is gearing up for the economic outcome of the second wave of COVID-19 with a series of measures aimed at increasing liquidity and broadening the entire system. We're going to discuss today on what those measures are and how they will really help ease the process along as we face up to a second wave. But before that, let's listen in to what the governor said.
The recent surge in infections has, however, imparted greater uncertainty to the outlook and needs to be closely watched, especially as localized and regional lockdowns could dampen the recent improvement in demand conditions and delay the return of normalcy. Against this backdrop, the MPC judged that the monetary policy should remain accommodative to support and nurture the recovery. In other words, the stance of monetary policy will remain accommodative till the prospects of sustained recovery are well secured, while closely monitoring the evolving outlook for inflation. Let me now provide an assessment of the growth and inflation position and the outlook. Let me focus first on growth. Global growth is gradually recovering from the slowdown, but it remains uneven across countries and is supported by ongoing vaccination drives, sustained accommodative monetary policies, and further sizable fiscal stimulus.
Okay, speaking to me now is Tanvee Gupta Jain, Chief India Economist at UBS Securities, Radhika Rao, India Economist at DBS Bank, and Aditi Nayar, Principal Economist at ICRA. Welcome to all of you and thank you for joining us on the show. Tanvee Jain, let me begin by getting your take on the overall message which came from the Reserve Bank of India today. What were the big takeaways for you?
Thanks, Tamanna. I would say the RBI policy was very much in unexpected lines, but the best thing what came out in today's policy was RBI very categorically made it very clear that they are going to retain accommodative stance as long as necessary. And they are mindful of the COVID-19 resurgence, which we are seeing across India. So a couple of things which we want to highlight from the policy specifically. One, the policy rates have been kept unchanged. Second, they have maintained their accommodative stance. Third, they are willing to provide liquidity and government and policy support to the extent possible to ensure that the yield curve is flattening rather than steepening yield curve, which would have been a consequence because of a debt sustainability concerns, what we are seeing right now. Fourth, while they have not really changed their GDP growth estimate, they are still retaining 10.5% FY22 real GDP growth. They have kind of clearly highlighted that they are mindful of how the COVID-19 uncertainty is going to pan out overall on the macroeconomic variables. Lastly, they have tweaked the inflation forecast, as you were highlighting, very marginally. The average FY22 CPI inflation is now coming at 5% on an average, which is very much in line with where the markets were expecting. I think the highlight of this policy was the GSAP #1 program, which they kind of highlighted, which I would say is a kind of quantitative easing program, which clearly is going to support the bond market going forward.
Let's talk a bit more about the GSAP program, Radhika Rao. So a new idea in the lexicon of the tools that the Apex Bank has. The GSAP, the Government Security Acquisition Program 1.0, as they're calling it, looks at the central bank purchasing government bonds worth 1 trillion rupees, starts with a tranche of 25,000 crore rupees this 15th April. Break it down for us. How do you think this will impact the bond markets, and does it also signal that the RBI is more than willing to pump in liquidity at a difficult time?
Thanks, Tamanna. I think this is a very important junction. I think that was one of the most surprising aspects of this meeting. I think which otherwise it was largely along expected lines. I think markets have been for the past year or so seeking some form of a calendar, some form of clarity in terms of how the government would like to participate in the bond market, and particularly because yields in the past 6 months or so since rate recovery expectations had got momentum, you had seen, and also the difficult global situation, you had seen rates have begun to inch up. That coupled at a time when fiscal deficit as well as borrowings are going to be at a multi-year high. So because of that, markets were really seeking clarity. And I think what you saw from the GSAP was a couple of things. Number one, there's a clear assurance that the central bank is on standby and they would do what is necessary. They have provided it's a de facto calendar, at least for the first quarter, that is the June quarter. There is, you have got a size on hand, which is about 1 trillion, which is going to start as soon as this month. But I think we need to also remember that they're not really bound only by what's happening in the GSAT, right? Because they have also mentioned that this is going to be but one of the array of instruments that they have. And I think there is sufficient flexibility still that in the event that sometimes yields are not completely in our control. There are factors beyond, particularly if you see things like oil prices. If you see a spike there, and if you see, say, US Treasury yields again begin their upward march past 2%, or probably closer to 2.25. These are things that are beyond the central bank's control, and that can impact domestic yield curves as well. Particularly the long end. So because of these things, I think they need to inherently keep some flexibility in, which I think they have, will continue to emphasize on. But nonetheless, it is an assurity that they have a protracted plan in place, which is start with the first quarter. So if you say, one quarter, 1 trillion quarter, that's about 4 trillion plus HTM help to the banks. We are looking at a sizable amount of support from the central bank, which is certainly a big positive. And I think in this environment where rates are generally going up, it is very important to keep a very firm hand in terms of bond yields. How will it, to answer your question on what will it help in, it will certainly help in keeping the yield curve, relatively flat. We have to remember from around the belly is where usually borrowing costs are hinged for the corporate sector as well. So that becomes important, and longer end, particularly as a benchmark for borrowing costs, is also very important. So they would continue to act. I think a benchmark is of course a 10-year, but I think that they would act across the curve and much more to keep the curve as flat as possible.
Aditi, was GSAP also the big takeaway for you? And what were the key highlights? What was the big message you got out of the governor's speech and then what he said at the press conference subsequently?
Sure, Tamanna, thanks. In terms of the key takeaways, I think there are 3 or 4, and Tanvee and Radhika have already touched upon them, but I'm just going to recap, in terms of what we thought the key takeaways were. First of all, as Radhika just mentioned, the average inflation rate in FY22, the MPC has projected at 5%. And that is something which is significant. And this is, the first point that I want to make, that based on what the MPC is projecting, we neither see any space for the rate cuts going ahead. And also, we don't think that there's going to be any early move toward really rate hikes, either for the repo or for the reverse repo. So as of now, based on the commentary and the projections made by the MPC, we think that the repo rate is going to be on hold through 2021. And we think the reverse repo rate is going to be on hold at least in the first half of this fiscal year. So that's point one. Secondly, on the accommodative stance, just to add to what we had said earlier, I thought the language was really important. The fact that there is no explicit time frame that has been mentioned now, as far as the accommodative stance is concerned, really means that the MPC is going to be data dependent, and including looking at the data on what is happening with the COVID-19 infections, vaccinations, etc. I think all of these are going to be really important data points going ahead. The kind of uncertainty that has been reignited in the last few weeks, not only by the rising infection rates, but also by the localized lockdowns which have come back into force, which have had to come back into force to be able to deal with the evolving situation. The uncertainty really is going to quell only over a period of time once we have a large part of the population which is got access to the COVID-19 vaccination. And this is only going to happen over a couple of quarters. And therefore, looking at the language used by the MPC, we believe that the accommodative stance is also here to stay, at least for the first half of this fiscal year. So that's another one of the key takeaways. And now coming to GSAP, definitely that is something that the bond markets had been hoping for, and I've cheered today. This is reducing some of the uncertainty which is there in terms of the inherent uncertainties that are created by a large fiscal program, a large borrowing program, inflation rates that are at well above the midpoint of the MPC's medium-term target range, what's happening globally in terms of yields and commodity prices, etc. So the view that we have now is that the committed amount of OMOs that the RBI has announced today in terms of what they'll be doing in Q1, plus the option that there may be more in case there is a requirement if things are disorderly, accompanied with the fact that when we look at all the data that we got last week on the government's fiscal situation, which is really pointing to a couple of things. One, the fiscal deficit of Government of India is likely to have undershot the revised estimate. But there was only a very small cancellation of the last auction of Government of India securities that had been planned for FY21. So what we believe is that the cash situation that the government has moved into FY22 with is fairly comfortable. And this is also something that should help to ease yields and should help to flatten the yield curve in line with what Radhika was mentioning earlier. And of course, the other factors, the global factors will remain important. What happens as far as the US treasuries is concerned, what happens with commodity prices, particularly crude oil, and how that seeps through into the inflationary outlook. And therefore, we now think that the 10-year GSEC yield is likely to be closer to 605 to 615 rather than the 635 that we were fearing for the end of Q1.
Okay. Let me come to the broad economic outlook of what we have seen from the monetary policy and from the governor's speech. Tanvee, in the previous quarters and in the previous policy statements, the governor has been very clear about where we stand in the cycle. Do you think right now there is that the fact that the GDP outlook has been retained to 10.5%, do you think that the possible headwind of a stronger resurgence of COVID-19, a slower pace of vaccination has been factored into what we've seen today?
Sure, Tamanna. So if you look at where RBI is and versus say I compare it with our UBS estimate or IMF estimate, RBI is actually quite conservative in their growth numbers. They are projecting FY22 real GDP growth at 10.5%. At UBS, we are close to 11.5%. And the recent IMF publication is, maintaining it much higher at around 12.5%. So what it means. Now, what you're seeing on the ground is that there's a resurgence in COVID-19 cases, which started over the past month. Even if I discount for the resurgence in COVID-19 cases, if I look at the UBS India Composite Economic Indicator, it has started plateauing even in the months of Jan and Feb. So sequentially, I could see that my growth momentum was slowing in the March quarter on a sequential quarter-on-quarter basis versus the V-shaped recovery which we saw in the June and the September quarter. Now, with the resurgence in COVID-19 cases, there is definitely a downside risk emerging for the near-term GDP growth of the June quarter. So I would believe, looking at the RBI's estimate, they are sounding very conservative, 10.5%, even discounting for the COVID-19 resurgence, I think does not look at all optimistic or more downside, I would say, at that point in time. I would say there are much more downside risk at the moment, depending upon the vaccination pace as well as the COVID-19 cases, specifically on the impact on the mobility restriction that can have on my 11.5% real GDP growth estimate, which for FY22. I think what is very interesting from today's policy that if you look at over the past year, RBI was trying to manage a trilemma of maintaining cost of capital low because you want to support a nascent economic recovery, specifically after a pandemic-induced recession. They were trying to ensure that INR remains stable and range-bound because of a medium-term objective of gaining in the global supply chain shift. And lastly, the objective was to keep inflationary pressures under control. Now, this year, in this policy specifically, it came out very clear that RBI would like to support growth, and specifically in a very uncertain economic environment when we don't know how the vaccination deployment is going to be, when you don't know how many cases or economic uncertainty is going to arise because of a COVID-19 resurgence. So in that sense, what you're seeing right now is that the second objective, which was to keep INR range bound, is something which RBI might accommodate in the near term rather than fight. In fact, we are seeing that because of the downside risk to India's GDP growth. It's a downside risk versus our 11.5% GDP growth estimate. Stretched equity market valuations, generally slower US dollar flows in the months of April and May. We are seeing that USD INR could actually track towards 75.5 in the very short term. So that is something which I would say in trying to manage a trilemma, the RBI will manage the lower cost of capital, but might have to be okay with letting INR depreciate a little bit to keep ammunition later, maybe in the form of using that space to do OMO purchases later, or maybe to curb INR volatility later, depending upon how the global economy is shaping up.
That's an important point, that the RBI needs to keep its gunpowder dry as we wait and see how this situation unfolds. I want to thank all of you for joining us on this discussion today as we break down what occurred in the MPC.